All right, I'm on the next page of notes where we have some bonds issued at October 1st, 20X0. They have a maturity of 10 years, have a stated and market rates both equal to 8%. The first interest payment will not be paid until September 30th of the following year. So first, let's figure out what bonds they're talking about, right? So the bonds here are going to be these bonds payable that are listed at $300,000. So those bonds were issued at a face value of $300,000. When they were issued, the original entry would have looked something like this. We would have had cash for $300,000, and we would have recorded those bonds at $300,000. Of course, we're dealing with an asset. We're receiving cash. We are also incurring a liability because we're borrowing this money. We have a creditor giving us this money. This happened on 10/1/X0. The whole rigmarole about stated and market rates equaling, that just we don't have to worry about the present value. If the stated and the market rate are equivalent, then bonds issue at the amount of cash that is equivalent to their face. Simplifies the accounting somewhat. Of course, you'll complicate this accounting. We'll actually complicate it a little this semester, but it'll get really fun and complicated in intermediate too. Now, the first interest payment, we're not going to pay interest on these suckers until actually pay the cash until September 30th. Of the next year, right? But these are already in our possession. They are accruing interest with the passage of time. So we do have to make an entry that records some amount of interest at the end of the year. Again, in accordance with the matching principle, right? This money we got went into our operations, funding our operations. Well, part of the expense of this money is that we're going to have to pay interest on top of the $300,000 we eventually return. So we are going to record interest expense, and we will have to pay that interest eventually. So we'll have interest payable. Now the question is how much? In order to figure out how much, we take the principal, we multiply the interest rate, and we multiply that by a time factor. Now, when we multiply the time factor, we're assuming that the 8% is an annual interest rate. I'll have to make some modifications. You can always assume in my class, unless otherwise stated, that any percentage rate that's quoted to you is a percentage. So that means that we're going to be charged 8% over in a year's time. Now we're only talking about months. So in order to figure out how much we should actually record, we're going to divide this 8% by 12 to figure out the per month amount of interest, and then multiply it by 3 because we have October, November, December, 3 months of interest to accrue. So we have 300,000 times 8% times 3/12. And again, so 300,000 times 8% is 24,000. 24, this reduces down to a quarter. 24 divided by divided by 4 gives me 6,000. So this is the amount of interest I would want to record for the period. Now, one mistake I often see made here is people want to credit bonds payable for the interest. But this is principal. This is only principal. We want to separate out in our accounting records interest versus principal. So do not credit bonds payable. The other thing I see people get hung up on is they take that 10 years to imply something about the math they have to do to figure out interest. 10 years just refers to the maturity of these bonds. We will have to pay back the $300,000 in 10 years. So it has nothing to do with the per year interest. So don't worry about whether it's a 3-year bond or a 10-year bond or a 20-year bond. That's moot in terms of calculating how much interest you should recognize for a particular period of time. For the classification, again, is the cash coming first or is it coming later? Now, ignore this cash because this cash is, again, tied up in principal. The cash we're worried about is the cash we're recording vis-a-vis the interest payment we're going to make. So here we're actually recording the expense prior to paying the cash, which will be due at September 30th of the following year. So what we have here is in the case of an accrual. The next one is typically one that students don't have much of an issue with, depreciation and amortization, or in general, just allocating the cost of fixed assets. It says that Bevo's building is depreciated 30-year useful life, no salvage. So we got 30 years of revenue generation in this building. We're not anticipating any residual value or salvage at the end of those 30 years. The equipment is being depreciated over a 10-year useful life, 10 years of revenue generation, again, no salvage. And the patent has a 5-year useful life with no salvage. So we have all of our assumptions about how we're going to generate revenue from these fixed assets, and we have no salvage. We're also going to assume that the company uses the simplified, most simple cost allocation technique, straight line depreciation. So now all we need to do is take a look back at our trial balance, our unadjusted trial balance, and find the historical costs of these items. This $500,000, remember, is the building's historical cost. This is not adjusted by depreciation. The depreciation is actually recorded in a separate account. So we have a $500,000 building that's being depreciated over 30 years. That tells me how much of that expense, I paid out at some point. I paid $500,000 for this building, cash. Now, do I want to recognize that cash in that same year? No, I want to spread it out over 30 years by the matching principal. We have $16,667 per year that would be recognized. The equipment is $50,000. So we take $50,000, its historical cost, divided up over 10 years. And that would just be $5,000 per year. And finally, the patent, a 5-year useful life. What is the cost of this patent right now? The patent is at a $20,000 cost. So over 4 years, then again, we have $5,000 per. Oh, I'm sorry. It's a 5-year. 5-year. It would help if I read. So it's a $4,000 per year allocation. Now making the journal entry for the building and the equipment, it's going to be a remarkably similar journal entry. I'm going to do it in a very particular way. You wouldn't absolutely have to do it this way, but to me it makes the most sense. We would record depreciation expense as one account and separately record the accumulated depreciation for the building and the accumulated depreciation for the equipment. At the very least, we would need to separate the accumulated depreciation for those two assets because they are separately listed on the unadjusted trial balance. Also, if we go to sell or dispose of this building or this equipment, we would want to have the amount of accumulated depreciation connected with those assets separated so that we knew what we needed to zero out at the point of disposal. If you haven't worked a fixed asset sale, like the sale of a fixed asset, like a building or equipment. There are some examples in case number 2 of the problem set in module 1 that you should look at. They're not complicated, but it is something to be to take note of. So we're boosting the accumulated depreciation of the building by 667. My little terminology doesn't work so well in this problem. With that, it would be like 16.667, and the accumulated depreciation for the equipment would be 5,000. And so that means our depreciation expense overall will be 21,667. Now, we're going to record the patent separately because we do not apply depreciation to intangible assets. It's going to get split up by this line, and that just bugs me on some level. So I'm going to write it down here, but for no other reason than I'm OCD like that. So this is for the patent. Now, patents, instead of depreciation, we call it amortization. It's the same process. It's the same idea. It's just matching the cost of the intangible asset. And that's what amortization is applied to. Amortization is cost allocation of intangible assets. And those are different than fixed assets. We'll talk a little bit more about like how they're different when we get into the balance sheet chapter. But for now, just take my word. Anything that's an intangible asset is going to be using an amortization expense rather than depreciation expense. The other interesting part is the convention for recording cost allocation of an intangible is not to credit a contra asset. It wouldn't be incorrect, but it's just generally not done. Instead what we do is read the value of the patent directly. We cut out the middleman. We don't credit a contra account. We just credit the asset account directly. And I could give you some of that intuition. It's not really necessary for this video, or the intuition behind why I think that is, but not really needed for this video. You can ask me in class if you'd like. If it's just a burning question in your mind, there is, I think, some intuition behind it. Anyway, but we're recognizing net income, we're reducing an asset, and we're doing the same thing up here. We're reducing net income for the depreciation expense, and we're reducing assets by crediting not an asset directly, but a contra asset. All of these are examples of deferral events because we spent the money on the asset whose cost we're now allocating over time. So the money happened when we acquired the asset, the building, the equipment, the patent. Now, later dates, we're recognizing any cost allocation, any expenses that are due to that. Oh, and I noticed just now that I haven't actually followed the T accounts. For the interest expense and interest payable, there was none recorded in our unadjusted trial balance. You could take a look back at that and you would see, oh wait, we only have 3 liabilities here and none of them are interest payable. And we look at our expenses and there is no interest expense. And so both of those would be brand new accounts created during the adjusting entry process for $6,000 a piece. So there's not much action going on here. It's just taking an account that didn't exist and creating a balance for it. There is a little bit of action that happens with those that fall with these cost out entries. We have an accumulation for the building. We have accumulated depreciation for the equipment. And we have the patent. And we have depreciation. And we have amortization. So we got a lot of stuff going on here. Let's do the easy ones first. There was no depreciation expense. You can check it. But now we have 21,667. Again, I hate it when I can't use K's because it just makes things so much easier and prettier. 667. So that's a debit balance there. For our amortization, we got a $4,000 debit. That started at 0. I didn't give myself any room, but it's now 4,000. That's what will go to the adjusted trial balance. The patent on the unadjusted trial balance was 20,000. So it had a balance of 20,000. We now brought that down by 4,000. It has only a $16,000 balance remaining. The accumulated depreciation that we put to the equipment account was originally 5,000. We just upped it by another 5,000. So now we have 10,000. That's going to go to the adjusted trial balance. All of these numbers are on our adjusted trial balance now. Finally, the accumulated depreciation for the building on the unadjusted trial balance says it's at 95,000. 5,000 prior to us. We've adjusted it by 16,667. And that would create 101 and $111,667 of a credit balance after it was appropriately accounted for. Now there's one more item, and this is always the final adjustment to happen is the tax rate. And I'll just give you a tax rate. And then you're going to have to use that to understand, oh, well, things are taxed. And it's the final adjusting entry because our tax adjusting entry has to include must include all unadjusted revenues, expenses, gains, losses, and all new adjusted revenues, expenses, gains, losses. So when we're making the adjusting entry, basically what we want to do is figure out what our pre-tax income is. Pre-tax income from a bookkeeping sense is very different from pre-tax income that you'll study in preparing income tax or income taxation, right? It's a whole different world over there in the IRS. In the financial reporting world, we do a very different sort of simplified tax structure. So pre-tax income, we take any revenues, we subtract off any expenses, we add any gains, we subtract off any losses, spell it out to differentiate it from liabilities, and this gives us pre-tax income. Now remember, it has to be all of them. So in this case, we're going to take that $300,000 of revenue from the unadjusted trial balance. We're going to take the $20,000 of rent expense from the unadjusted trial balance. We're going to take the $50,000 of salaries from the unadjusted trial balance. We're going to take the $10,000 of insurance that we adjusted for. That was an insurance expense. We want to take any of that wage expense that we adjusted for on top of what was already recorded. And again, wages or salary, I'm not going to count points off if you use one versus the other. It would be an insanely arbitrary, stupid way to deduct points. Revenues that we recorded at the end of the period, $25,000 from that deferred deferred contract. We have $6,000 of interest expense that we recorded as part of our adjustments. We have a total of $21,667 of depreciation expense, again throwing off my lovely K as 1,000. And we have $4,000 of amortization expense. Both of those are expenses. So this is a brilliant way to lay out your work for an exam, because it shows me everything you're including. That way, if there's a problem and your number's totally off, I'm not guessing at what you included. I can give you some partial credit for like, oh, they included everything, but they forgot the additional revenue. Well, then that's only like maybe a half a point off because they got everything else in there. So showing your work is vital for me to give you every single point you deserve. Make sure you do that. So if we go ahead and add all these guys up, add those two, subtract everything else, we get 208,333, right? This is our pre-tax income. We multiply it or apply the tax rate of 20%, 0.2, and that gives us our $41,667 tax expense for this year. All right. Let us now make an entry. How do you record tax? How do you record this adjustment for taxes on 12/31/X0? We are going to debit tax expense by that amount, $41,667. We are also going to credit taxes payable because we typically pay our taxes at fixed points in time, but we estimate them in advance of that payment. So we're not going to pay that cash now. We're going to recognize the expense now. Why? Because that expense arose from all this money we're making, right? We made $208,000. Now we have to cut the government their piece of it. That's the expense we're going to recognize. We're not actually going to cut that check to a later point in time. It does decrease net income. It does increase my liabilities because we're recognizing before we're paying. This is a type of accrual. The recognition of the expense is preceding the payment of the cash. What do folks do wrong here? They tend to forget either the unadjusted items or the newly adjusted items. So make sure you include both. Remember, there's a reason why we do this last. It's because we want all of these adjustments to enter into our calculation. That is a lot of points off if you forget that. So don't forget that. And also the unadjusted pieces that were already in the unadjusted trial balance. The second thing they do wrong, and this one just blows my mind, they will only tax revenues. Holy crap, if we were taxed on pure revenue streams, that would be an insane world. No, we get deductions. Any money we spend in generating our profits is not taxable. Tax deductions, right, happen for a reason. These aren't the same tax deductions you would get in an IRS world, but they analogize well enough, right? Long video, but lots of explanation there. Hopefully you're taking it in, really thinking it through. Accounting is such a logical pattern. It's a system made by men to be used by men and women that will unlock and easily record transactions in a business. It is not arbitrary. There's always a reason behind what we're doing. If you're not sure what that is, ask me. And 95% of the time, I can give you a pretty good answer. All right. Talk to you soon.